What about we start? So hello, welcome everyone to this Market Thursday. We are October the 22nd. We are doing a bit different today as we are doing this webinar before the start of the day, before the opening bell. And I wanted to change a bit as we are doing the earnings season. So I thought changing a bit the habits and making something a bit different was worth doing. Quickly for the newcomers, an introduction for who I am. I started to trade in 2000 when I joined cash equity as a cash equity trader in Paris, Pierre Charon Gestion, and I worked in Paris for 4 years. In 2004, I started to work for Griffin Capital Management, which was running a European long short and a European long product. I started on the long product, then I joined as well their long short product, and I worked there for 4 years, where overall we had assets under management between 2 to 3 billion, and on the Western Europe part, we were running up to 600 million euros. In 2009, I joined Infinity Capital, which is the UK subsidiary of First New York, where I was running an absolute return mandate with no asset regions constraints. And since 2014, I've been doing mentoring. So I used to work for another mentoring company. And in 2018, I decided to launch my own mentoring program. And last year, in October of last year, I launched the 4x4 video series, which is hopefully going to help you having an investment process. So what are we going to be covering today? Today, as usual, we're going to be starting with the situation across asset classes, looking at stocks, credit, commodities, and FX. We're going to be doing a market review, looking at the recent performances, and more importantly, looking at what's going to happen next, what might happen next, which are the catalysts. We will be covering the housing market through the NAHB, the new permits, the financing. Why? Because the housing market has been pretty hot over the last few months. Then we're going to be jumping into the earnings season, today's earnings, and we're going to be ending this call with the Q&A session. So let's start first with, as usual, the asset class performances, looking on the left-hand side here at the year-to-date performances of the different asset classes. As we can see, the NASDAQ is really the big winner for this year. And on the other hand, we got Europe that has been struggling with the stock 600 being down 13%. FTSE is really the dog of the year, being down 24%. And versus that, we got emerging markets which are flattish to small up, and even quite up for China, up 9%. If we look at currencies, we can see that the euro has been strengthening quite a lot versus the dollar by 6%. The dollar has been quite weakish across and versus many currencies. If we look at commodities, the gold has been really strong based on the COVID and people flying and taking some risk off. And WTI, based on weak demand, has been very weak, down 35%. Let's jump now into the week-to-date asset performance. As we can see on the left-hand side, again, this is for the indexes, equity indexes, pretty weak across the pond, from -1% to -3%. There has been a start of a risk-off based on several factors. First, it seems like it is hard for US politicians to find a deal to get a fiscal stimulus before the elections. So there is a bit of rift between Democrats and Republicans. Plus, we had quite a big move in September on risk on, and there are growing uncertainties about the US elections. It feels like Trump is coming back in the polls. And actually, that's bringing a bit of uncertainty about the outcome, like in 2016, where he was lagging by quite a long margin, and at the end he won. And I think the market as well, two reasons. Market could be scared of uncertainties or disputed results happening, and the second thing is as we discussed before, I'm not sure that a clean sweep from the Democrats will be such a positive. Looking at the currencies, we have seen a weakening of the US dollar for this week. Gold is flattish, not really moving that much, and WTI is making his weekly moves, but at the end is still trading around the $40 level. Now let's jump into the sector level. As always, we get XLE energy, that is the weak part. I mean, energy has been really struggling this year, down 50% also. But what is interesting as well is we can see that at the bottom we get technology, which was down 2.4% on the week. So there has been some rotation in the market. So if you look at the FANG index, the Facebook, Amazon, Apple, Microsoft, and so forth, you can see that we have seen the top before in September, and since then we have been struggling. So we get the earnings season that could help as a catalyst. Netflix was down 6% yesterday. So more or less we have rotation ongoing in the market based on earnings season. Let's look now at the other asset classes. The US 10 years was later trading between 81 and 82 bips, so plus 0.81 and plus 0.82. So we have a reflation trade ongoing. And if we look at 2016, we discussed that last week. There was reflation trade and expectation that Trump will reflate the US economy. This is more or less what is happening these days. So the US 10 years, the yields are going up. But for Europe, actually looking at the German Bund versus the Italian BTPs, there has been a bit of widening. So I think it is obviously based on scared of second wave of COVID. But that is something to mention, that there is some pressure in Europe in the bond market. So you can bet that pretty quickly the ECB will jump again and be trying to reduce the spread between the Bund and the Italian BTP. The VIX trading around 28-30%. There is, I mean, it's a high level in terms of implied volatility. That again, that doesn't mean that it cannot go higher. But we are going into the elections with a lot of hedging, a lot of quite a high VIX. If you look at the future contracts on the VIX, it is obviously coming down, but still pretty elevated for two reasons. Again, a lot of hedging in the market. And secondly, because of this frenzy for call and options, there is, let's say, the volatility that is at the level that probably should not be in a normal market. In terms of top winners and top losers, interesting to see that you get the trading dog that are trading with huge volatility. But in the meantime, we get the earnings season that is kicking in. Snap yesterday was up 25% or so, meaning that if you beat the way Snap has been beating yesterday, you can expect the stocks to go through the roof. At the other hand, we get the fast line, which we mentioned last week, which pre-announced the numbers, and since then it has been going down. If you look at the chart, for those of you that are trading fast line, it feels like 73, 74 is the support for the level, so that is an important level. GSX, I'm happy to see that one down 35%. That is a good news. On CSFB, on Credit Suisse, downgrading the numbers. Two charts, as always. I'll try to do on top of what we've just done, some charts that I found interesting. This one is emerging market in orange and in pink, purple, Russia. As we can see, there was strong correlation at the start of the year, but since June, we had quite a divergence between emerging market and Russia, which could be explained by three things. First, you get oil since June that is trading sideways around the 40, and Russia being a massive oil exporters is a bit struggling with oil at this level. Secondly, we get the weakening of the US dollar. So that's true for that has been helping the emerging market. And as well, with Biden leading the polls versus Trump, that has not been helping Russia. But that is a chart that I found interesting. The next one is after this ETF, something that I'm looking at these days is the euro sterling. Or the sterling overall. Since 2016, obviously, we have been stuck with this Brexit election. So I think many people are not even bothered to be looking at the sterling anymore. But we clearly have a deadline here, which is the end of this year. You can argue that we had already many deadlines, but I think that the talks will really warm up, and I was looking at the chart since 2016. We had this trend between 0.82 to 0.93. What I want to say for everything that I was mentioning here and later and other webinars, this is just for education purpose. So I'm not advocating anyone to take a position or to do so. You are your own boss. You do whatever you think it's best. But I'm just trying to think and to show you what's the process when you want to generate ideas. So looking at being long the sterling here, I think you're probably going to have a 3% downside. And the upside could be around 9%. So if you think about the risk reward of 3 to 1, I think this is a good one. Looking at option is a bit tricky because if you look at the implied volatility at the money, I checked yesterday in the morning, the 1 month was at 9.4%. The 3 months, which will be covering the deadline on the 31st of December, is at 8.75%. And that will be expiring on the 21st of January. So that means more or less, if yesterday morning you were buying the 91 put, you will have a break even around 89.3, which is not that bad. Again, that is for you to make the decision. But I think for anyone that has been looking for FX IDs, that is, you get a catalyst coming. In terms of catalyst, looking at the macro and what we're going to have. So today, which is the 22nd, we get Germany before the open, and the consumer sentiment was a bit below expectations. So that's the same in France. So you can see that the confidence over Europe is coming down again, which makes sense based on COVID. On the way up, in 25 minutes, we're going to have the weekly claims. And at 3 o'clock, we're going to have the existing home sales. More importantly, we get the presidential debate tonight. So as always, you can make sure and you can be sure that tomorrow there's going to be a lot of noise on Twitter. There are already a lot of noise. Literally, if you are putting your conviction, your politicians' views every 2 minutes on Twitter, it's just that you're probably going to be a bad trader. It's not about, putting what you want to happen, but literally what might happen. So that's something to take care. Make sure to be careful on what you're reading these days on Twitter. Tomorrow, we get the Japanese CPI, but more importantly, we get all the flash PMIs. The flash PMIs, which are the leading indicator of the leading indicator, coming a week before, and are roughly 80% of the market PMI, and are going to tell us how the economies are doing. It is clear that Europe is not doing well, and you could expect market flash PMIs tomorrow morning in Europe to be below the expectations. Then in the afternoon, we get the US ones, and we have next week some Bank of Japan meeting, ECB meeting, and some other numbers. Quickly On the earnings, I only put the earnings for today. Normally, what you want to be doing is, as always, looking at the earnings coming for next week. So every single day you come into the office, you sit and you know more or less which companies are going to come and deliver their earnings. That is important on the sector level and industry level. And if you get if you get a single name position, that is even more important. That is something that we're going to be covering later during this call. Let me jump now onto the price action. You can still hear me, everyone? Yeah, still okay? You're following me, not sleeping yet? So let's start with the S&P. So the S&P is quite interesting because it's making lower highs. So we'll see about this follow-up. But over the last 5 to 10 days, we have seen weakness in the market. Again, I don't think this is only the talk of not having a fiscal stimulus, because fiscal stimulus there will be. Either it's now or in 1 or 2 months, but I think it's more elections uncertainties and the idea as well that I'm not sure that all the Democrats winning everything is necessarily a good idea, despite sometimes the headlines telling you this is a great thing. And here again, I'm not taking a stance about, what is if I'm Democrat or Republican. Interestingly, Euro stocks, so here I'm talking Europe, is coming into important level. That's the same as the DAX. Clearly, there has been weakness in Europe. We'll see if there's going to be a follow-up. I don't want to be spending too much time on these indexes. If we look at the euro dollar, that is a chart that we mentioned before. It feels like this is a really important level. If mine is stuck, yes, now it's back. So very important level on the euro dollar. It feels like the dollar is going to weaken even more. If you look at the DXY, that's a bit of the same chart where we have been in a downtrend. And despite people telling you for the last 3 months that the dollar is going to do fine, the dollar has been weakening and weakening. But really, the asset classes that has been moving quite a lot versus what happened before is the credit market. So the bonds, that's the US 10 years, which is now at 80 bips and above. Again, this is the idea of the reflation trade, about the steepening of the yield curve. So looking at the 10 versus the 2. We had same story in June. So that is coming every 3 months. And as I said, that was coming as well in 2016. The big difference with 2016 is we know now that there's going to be a massive fiscal stimulus. And this fiscal stimulus is going to be, if it's 2 trillion, that means 10% of the US GDP. So you can tell the size of it. As I mentioned before, there is a bit of tension on the Italian BTPs. So here, this is the chart of the Italian BTPs versus the German Bund. I mean, nothing scary if you look at the long-term picture. This is just some tension that we have over the last 5 days, but that might be interesting to see what the ECB might say next week. Emerging market are doing really well. EM, it's 50 to 60% China, and we know that China is clearly outperforming the rest of the world in terms of growth, in terms of expectations. So that is, you can see the translation in EM. I know that some of you are trading Bitcoin. So Bitcoin has been breaking out, so broke out yesterday. There was quite an important news with the PayPal announcing that they will take payment in Bitcoin, that you could be trading now cryptocurrencies. For me, that has always been hard to trade Bitcoin in size. Why? Because you get the counterparty risk. If you get big players like PayPal, that is clearly changing the game. And this is why you see some appetite that we started to see from yesterday. let's look quickly at some stocks and some rotation. So this is a peloton here. We got as well the solar ETF. We get Zoom. We get Enphase, and those are the names that turned quite a lot yesterday. Okay, so when we look at price action, we are always interested to be looking at 3 time frames: short term, mid-term, and long-term. And short-term, there has been some rotation, and despite the market being more or less flat yesterday, there were some big movers. Now the question is going to be some follow-up, but clearly each time you go into the earnings season, you see positions that are turning because people are taking some profit. And some of the names, like as I said, Fastly and Netflix, were quite disappointing. On the other hand, we had Snap that did very well, but that is telling you that there's going to be volatility probably around those names during this earnings season. So let's go back into the slides. I want to start with the US housing market. And here we get the chart, which is coming from the Fred, so the St. Louis website, on the new privately owned housing units completed. Okay, as you can see, we have been recovering quite a lot from the lows of 2010, but still we are quite far away from the highs that we had in 2005. Still, what has been pretty amazing this year is the housing market has been extremely strong in the US, mainly for 2 reasons. First, the cheap financing, meaning that if we look at the US 30 years, it is at a very low level. And the second impact is obviously COVID, because people are a bit panicking and want to move away from big cities and to go into and building new housing and going into the countryside. When we look at the US housing market, we have 3 different indexes. We get the building permits, which are the leading indicators, which translate into the housing start, which is what we call the coincident indicator. And then we get the housing completion, which was the chart that we looked before, which is the lagging indicator. So what really matters for us, as investors, if we are looking at what's going to happen next, is obviously the leading indicator, which is the building permits. So the building permits, you can find all the data on the Fred. This is what we have here. As you can see, we are at the highs since for the last 10 years. Again, we are at far away level that when we were in 2005. But what is interesting is if you look at the top of the building permits, it happened roughly in 2004, 2005. So 2-3 years before the collapse of the housing market. So far, building permits in the US have been holding pretty well. Again, COVID plus cheap financing have helped massively. I like very much so to be using another indicator, which is the NAHB. So the NAHB stands for National Association of Home Builders. So every month, if you go on their website, they are conducting a survey of NAHB members, which are home builders, to take what they say the pulse of the single family housing market. So you're going to have a great understanding of what is the single building market now and in the next 6 months. So you're going to have the leading indicators. And if you look at the report that we had a couple of days where the chairman said that the traffic remains very high based on record low interest and as well based on the COVID era. Having said that, we mentioned as well last week, there are some pressure and there could be some pressure on margins. Lumber could be not helping, labor as well, shortage of labor. And that's something that we need to identify when we look at home builders, and we're going to be covering next in different cases. So the housing market overall, if you take the blue line at the bottom, which is the private residential fixed investment as percentage of GDP, as you can see, it is much lower than it was in 2005, and it's representing, around 4 to 5%. So as a leading indicator of the US economy, that is far, far away than when it was before. And the trend has not been as strong as before. So if you were using the housing market as a leading indicator since 2009, that has not been as strong as before, and it is not a good indication. Nonetheless, we can see that obviously the housing services as percentage of GDP, the yellow one, is growing and growing, and the slope is staying the same, and the housing market as a percentage of GDP overall is getting bigger. So that making 16% of the US economy. So that is clearly a sector or an industry to be monitoring closely to have a better understanding of the health of the US economy. Something that we just mentioned about the 30 years fixed rate mortgage. So that is the cost of financing if you want to be borrowing money to buy a house in the US. Clearly the trend has been massively down. That we all know that is the same for the 10 years, the 2 years, any financing across the world. But that has been helping the market overall, the housing market overall. And we could ask ourselves if the recent move in the 10 years or in bonds could have some repercussion on the financing and on more importantly, on new financing. So if you look at the correlation between the NAHB and the building permits, you can see from this chart that started in 1985 that there is a strong correlation. The NAHB has been outperforming massively recently, but that is a chart that I like to be using to look at correlation, NAHB and building permits. Here we have the different players, some of the different players of the US housing market, where we get the ITB ETF, which is in orange, and we got 5 other players from Toll Brothers, LENA, Pulte, ADH Norton, and KB Home. And as you can see, the top performance are LENA, which is up 35%, and DH Norton, which is 32% for the year. I think what is even more interesting is looking at which home builders has been performing based on the average sales price. So if you look at home builders, obviously you get 2 drivers, which is first the positioning. So what kind of, what is the average price of the houses they are selling? And secondly, to which region in the US, because the drivers, if you are in Texas, are very different from the one if you are, let's say, in Kansas. But overall, if you look at the 2 winners, so which is Pulte and I was saying LENA, both of them have a median sales price around $395,000 versus $313 for the median sales price for new houses in the US. So the positioning is close to the average sales price, a bit higher, but this is not top end, and means as well that, you know, it is mainly middle class plus that are moving from big cities and that are building new houses. Same chart with looking at LENA versus PHM since 2010. Again, you can see the correlation, and that means that to do over the long run, if you look at these 2 charts, that has been pretty hard to be generating alpha because the alpha is more or less the same. But there are some cycle into the big cycle to generate alpha, as we've seen on the chart before. So that is for the year, LENA up 48% versus PHM up 20%. Again, that is interesting. LENA, which is selling at $395,000. The house got a net margin of 10%. The market is expecting revenues to go up by 8% next year and 4% the year after, versus PHM, which has a higher net margin, and where the sales are expecting to go up by 14 next year and 10% the year after. So despite the long-term hardness to be generating alpha, if you take the picture over the last 6 months, there has been quite widening between the different players. So I want to jump now into the earnings season. That is a similar chart that the one I used last week, which is this S&P 500 percentage of weekly upward annual earnings revisions. And even if it's pretty high, it feels like the market is a bit toppish in terms of revision. So if you look at the bottom, that was at the end of March, start of April, a week before the market bottomed. And it feels like it's going to be hard for the market to go higher unless we get earnings revisions on the way up. And that is important. Why? Because we are in the middle of the earnings season. And more importantly, many companies are expected normally to give us expectations for 2021. But because of the low visibility this year, it's harder than any other years, meaning that the consensus are going to be struggle to find what we should be expecting for 2021. Another chart that I find pretty interesting, which is from MSCI and from the Marketeer, which is the earnings sentiment, where you get on the numerator the upgrades minus the downgrades, and on the denominator you get the total estimates on all stocks. Similar picture here, where we at the bottom at the end of March, which is very similar to when the market bottomed end of March, and we had a peak a few weeks ago. Again, there is a strong correlation between the S&P and the earnings revisions and the earnings expectations. So we are in the middle of the earnings season. So from 10 days ago to now, we had for the S&P 500 97 companies that came with their numbers, which makes 22% of the market value. But more importantly, next week, it's going to be a very busy week. We're going to have 182 issues, which making almost 50% of the market value of the S&P. So you're going to have every day some big names coming with earnings. So it's going to be a very busy week in terms of earnings. So far, I checked this morning before the call. I went through the earnings season and I picked 112 companies with 1 billion market cap and above. 80% of those companies beat on the revenues expectation. 80% beat on the EPS expectations, which is higher than the 73% that we have normally for the S&P 500 5-year average. So far, the earnings season has been better than the average. But there is a but, is again, the expectations and what are the outlook. And here we don't have much color on what's going to happen in the next few quarters. And I think this is why the market is a bit struggling. One of the reasons. The median move on the day for companies that came with their numbers was plus 0.5%. Quickly, the top winners and the top losers. We have seen some big moves. By definition, if the company is beating expectation, you get a higher odds of the company having earnings momentum going in its favor. But as well, what is important is the outlook. So if you take the example of iRobot, which came with better numbers, it's as well about the outlook, and you get the names that are always struggling, like XLE, oil companies that have been struggling. And as well, on the losers, we can see two names, Bank of America and Citigroup. So the banks have been struggling. The earnings season always starts with the banks, and if the start of the earnings is coming with some disappointment like we have in the bank, that means we really need a strong bit afterwards for the market to go much higher. So clearly next week is going to be extremely important because we get many big names. The problem is after this week of big earnings, we get the elections coming. So more or less what you have over the last 10 days is people are reducing their exposure coming into this election and hedging their portfolio. So today, earnings season, that is Mattel, Intel. So you can be, I strongly advise you to be using different websites to do the follow-up. You get Earnings Whispers, you get Benziger. Those are extremely helpful websites if you don't have access to more, let's say, more financial software. Everything is for free. That is helpful. That helps me. So earnings season, if we take the example of today, because, you know, this is why as well I wanted to do this call. If you look at the implied move from the at-the-money call put expiring tomorrow on Friday, and I took those one a couple of days ago, the move that is expecting today on AT&T is at 3.7%, American Airlines 7.2%, Freeport 6.4%, and Pulte that we mentioned before 5.7%. So I think Pulte is up 1% at 45.70 pre-market, and after beating the expectations, so they came with $134 EPS for 1.12 expected, and they beat on the revenues as well. But what is important for me and what you should be doing as well is looking at what is the expected move by the option market on the earnings day. And that tells you first in terms of risk management, if you have a position, what kind of move the market is expected, and or if you have a view on the expected move, playing the volatility on that day. That is not something that I strongly advise to do. That is really a professional game. That is a tough one to do, but at least understanding what are the expectations on the day are pretty helpful. So today I wanted quickly, because again, this is we are in the middle of the earnings season, is looking at the Freeport earnings. So Freeport McMoran, which is doing mainly copper and gold, producing copper and gold, mining copper and gold, sorry. So we got the numbers we're expecting as 745. I think now they came with the numbers, but unfortunately it came just after the call. But the expectations were for roughly 20 cents and $3.7 billion on the sales. And why I wanted to do Freeport is because I wanted to play the second derivative. So for those of you who have been following me, you know how I like playing the second derivative. If you think about two commodities that have been moving quite nicely recently and more long-term, is the copper and the gold. The gold is up 30%, as we've seen year to date before. And the copper has been pretty strong recently based on China's demand. So to me, very often you don't want to be trading the noise. So you don't want to be trading like the sales trader, you know, the copper or the gold, which are overcrowded and making some noise. But what you want to be trading is the thing that are the second derivatives. And by definition, Freeport will be benefiting massively when copper and gold are going up. Just in terms of risk management, something that you should be checking. So you get the earnings coming before or after the trading hours, but more importantly, you should always be checking when is the company coming with their conference call. Okay, so if we look at here, 10 Eastern time, meaning that Freeport will be updating about their outlook for 2021 during the trading hours, meaning that sometimes you could be putting a position not knowing that the company will update through the earnings, through their conference call during the trading hours, and suddenly the stock will be moving. And you'll be asking yourself, what is happening? So if you have a position or if you are interested, actually make sure that you know when is the company coming with a conference call, and best will be even more to be listening live to this earnings call. So if we look at two cases that we discussed today, Pulte is now flat on the day pre-market at 45.20, and Freeport is flat as well. So Freeport, again, as I mentioned, why I wanted to look at Freeport is, yes, because they got the earnings, but I don't want to be trading the same as everyone, which is the copper and the gold. I want to be trading the second derivative and doing a bit of homework. So here we get the copper futures chart. As we can see, that has been bouncing quite nicely for the lows, and it is up on the year, meaning that Freeport, which part of their business is copper, is going to be benefiting from it, and obviously will be benefiting massively from the gold being up 30%. So if we look at the expectations, and here this is another struggle for the market that we mentioned, is expectations for Freeport in 2021 are pretty high in terms of revenues, as the market is expecting 30% revenue growth and big increase in free cash flow and EPS. So as always, it's not only how you do and how you beat the expectations, but how is your outlook and how much is priced by the market. And as the market has been bouncing quite nicely and quite a lot, it feels like a lot, as we mentioned with the chart from Marketeer, has been already priced by the market. Similar, at the end of the process, what I like to do is looking at the chart of Freeport. Why? Because that tells me about my risk management and the price action. So as we discussed, we know that the expected move from the option market is around 6 to 7%. As you can see in this chart, which is the chart since the lows of March, it has been trading in a range. If you take this middle of the range plus minus the move expected, you end up with the range that you have here, more or less. That tells you as well, if you have a position or if you want to enter a position, which level that playing with the odds on the low range, mid range, or the higher range. So again, that is the process to be using. That is more for being short term and understanding which companies are coming with their earnings, and as well, making sure that even if the earnings are out, we are not going to be screwed by the earnings call being during the opening, the trading hours. Next week, I want to be, and I'm going to be doing an how to trade US elections webinar. So this one is not a free webinar because it's more advanced, and so it's going to be about, instead of doing the markets Thursday webinar, we will be looking at how to trade US elections. So we'll be looking at what happened in the past and potential ideas, both short-term, mid-term, long-term, and across asset classes. So that will be after the US close. There's going to be quite a lot to cover, and hopefully I can help you guys being successful, not only on the day of the US elections, but in the next few months after it. Quickly for the new joiners, the education that I offer, first the 4x4 video series, which is a comprehensive online video course to get a professional investment process based on my 20 years experience as a portfolio manager and over the last 6 years as an educator. This product was launched in October 2019. I have roughly now between 50 and 100 people that subscribe to the product, where I help people generating ideas based on 4 filters: top-down, bottom-up, special situation, and active trading, where you're going to get 40 plus videos, 30 hours of footage, and 50 plus Excel spreadsheet that I try to update monthly. and you're going to have access to it. You're going to have as well access to the sources, so you're not going to be paying stupid dollar just to have those Excel and those macro data. Second part of my education is the mentoring program, which can be done after the 4x4 video series. But if you're an experienced trader, I can probably help you being a better trader. What I do is a 12 weekly one-on-one online sessions on Skype, where I help you building your infrastructure and learn how to trade your money in real time. So you'll be coming to me with your broker account, and we're gonna be together over 3 to 5 months building your track record, building your knowledge and your investment process. Similar to the 4x4 video series, I don't want you to be stuck in some top-down or some macro-only ID generation. So I use my experience as both a trader, hedge fund manager, portfolio manager to do top-down, bottom-up active trading and special situation, where we will love to do a consistent ID generation and being able every week to be putting new positions across asset classes, timeframes, and strategies. And you could be doing it either because you want to have access to the industry, or because you just want to be growing your own wealth and become more independent. Quickly, Q&A session before the US Open. If you have some questions, otherwise, maybe you have to be trading the market in pre-market. Questions? A question from Matthew. Do you leave your spread open during earnings release? So when you get a spread and you get and you go into the earnings season, normally what you do is, if you are well in the money, it's obviously better because you can decide whatever you want to do. And you are in a position to say, okay, I want to keep the position or not. What I like to do is sometimes to be buying out of the money protection. Okay, so if you long something and short something, you say, how much does it cost me for an unexpected move on one or the two stories to be moving? You're not going to be doing at the money because it's going to be, the implied volatility is going to be pretty high. So it's a case by case. You might be reducing exposure or doing a bit more hedging. And obviously that depends on your style. What I don't like to be doing is putting a position right before the earnings. I think this is complete stupidity, and this is why people are losing so much money. A question from Balder. I have a bit of random question for an upcoming job interview. If you have a cash equity acquisition by, say, IBM for Red Hat at a premium, you can assume shareholders and regulatory approval. What would happen to the price of IBM post-announcement? So on the IBM acquisition, that is an interesting one, because one of my mentees was and is still short IBM. So last week, no, 2 or 3 weeks ago, they came with this pre-announcement saying we're going to split the company. And when we were doing the mentoring program with Shaw, I told him, you need to be careful, because there is that is a special situation, and that is a way for companies to unlock values. The thing is, if you look at IBM, we know that their business the core business has been struggling. If you look at the acquisition that they made, Red Hat, they made it at a crazy price. So they did it in 2019 at a very high premium. Why? Because they were very late to the party. So when you're late to the party and you want to do cloud business, you're buying something on very high. So they buy something on multiples for revenues growing 20-30% when the company was growing 10% revenues. So that means at one stage, what do you need to do? You need to realize your losses and say you need to write down your losses. So what's going to happen at one stage, IBM is going to tell the market, look guys, we made this acquisition for 20 and actually it is worth 15 or 10. And that is really something that you need to be checking when you look at how a company is going. A company could be going more or less two ways, either organic or through acquisitions. Okay, so if you go organic, that means either you get a good product, you get a good market, you get a good management, whatever. If you go through acquisition, that means you're just acquiring new companies and it comes at a price. Okay, so if you look at the example of GM, if you look at Siemens, if you look at those big holdings, they were making acquisitions after acquisition after acquisition. But at one stage, if you're making bad acquisitions, you will have to write down the price of your acquisition. And then that means the market could realize that you do have like a bad management. If you look as well, by very often those companies will be buying hot industries. Okay, so if you look at IBM, again, they were late in the party and they bought a cloud business, but they had to pay a premium to that, and they were so late and so wrong that now what they want to do is say, okay, the whole business we want to split this, split this old business, and this new business we would like to have the valuation, the kind of, you know, instead of being trading at 10, 20 times earnings, what about you put the valuation of this part of the business similar to the companies that are trading on between 30 and 100 times earnings? But that is possible if the earnings are going well, and as well if the management, if there is a story behind it. Okay, I hope it helps, Balder. Mathieu, I use EPS and revenue estimates to set a target price, but the difference between the two targets can be totally different. I mean, Mathieu, I mean, probably you could be doing some DCF model. I'm not a big fan of DCF model. I used to, when I joined my hedge fund in 2004, I remember spending 2 to 3 months going through DCF models. And at the end of the day, DCF models, you put whatever the price you want to put at the end and some discounting numbers, and you end up with the numbers. So I like the peer valuation first, because, you know, if you look at peer valuation, if you think about, you know, how much you pay, for me, peer valuation is exactly the same as buying a house. And I always say the same during the mentoring is, if you want to buy a house, you'll be coming to the street and you'll be checking the price of other houses, what is the quality and how much will be, more or less what will be the price. So there are some multiples. We are in a world where we are overpaying, you know, investors are very keen on paying big for anything that is showing growth. Okay, so if you think at the big picture is a world that's going to be going 2 to 3% world GDP. That means if you had 10, 20% revenues plus growth, investors have been very keen on paying it. Now the question is, if yields are going up, is value versus growth coming back? That is a debate that has been around for quite a long time, and growth has been killing value. So the trend is still my friend. In terms, to come back to your question, Matthew, I think, Matthew, it's EPS is kind of misleading. Okay, so you need to be looking at free cash flow, at return on equity, at return on capital employed, and to see if the company is really generating free cash flow. And for me, that is, over the years, the best metric to see really if the company is creating value and how the company is creating value. That means based on X equity, how much dollars can you be making? What else do we have? A question from Clark. Do you have any view on using time stops for managing trades which are trading sideways, which haven't hit your stop loss or achieved your soft target? Yeah, I mean, I don't have a written rule, but there are two things that I like to do. Is sometimes when you build a portfolio and you feel like nothing is working, I have nothing against cleaning the whole book and say, okay, I need to start from scratch. Okay, because when you end up with 10, 20 positions and you feel like it's all over the place, what about you restart? If the question here is more about, you know, if I have a position that is more or less nothing is happening, the first thing that is important here, and that is a big warning for people that are telling you to be trading only through options, which I think is a big fallacy and a big danger these days, is if you only trade options, you are long theta. Okay, so more or less, if you build a portfolio, very often you long theta. If you long theta and nothing is happening, so if you have 5-6 positions, let's say for the next 3 months, the market, nothing is happening, you're gonna be piecing away the P&L, piecing away the premium. So that's the first thing. So when you build your portfolio, don't only do options, because that doesn't work. And trust me, it's gonna be painful. The second thing is the stop for managing the trades is when it's trading sideways is, I think is, if the catalyst, I mean, normally when you put a position in a blue sky scenario, you're putting a position based on thinking there is a catalyst coming, okay? As long as the catalyst is not happening, normally you should still be putting the position. But, you know, unless you get a cost of carry that is pretty big, at one stage you might be cutting the position. It feels like, you know, sometimes you're better off, again, cleaning your portfolio, cleaning the 2-3 positions where nothing is happening. But if, you know, this, if that is a free option, meaning that it doesn't cost you much to being long or short something and the upside is pretty significant, then you should be, I think sometimes it's worth keeping it. How deep, if interest rates go negative, do you see this affecting building permits, housing? So for negatives in the US, we still get a bit of room. We'll see later. I think there is huge appetite for housing these days. I mean, it's not that I think, it's pretty obvious. We know the drivers, but now there are some hurdles coming, and I think if you look at how the expectations have been pumped up for the whole sector, I think the risk reward is not as positive as it was a few months ago. What else? Last one. You got anyone else? No? Maybe it's time to go back to trading. So we get, what do we have? We have, where he's just checking at Freeport. Freeport is trading, yeah, it's flattish, and Pulte is a bit down. So if you want to be trading the market over the US elections, you don't necessarily have to do it. I'm not saying this is the smart way. But you know, I'm going to be doing covering risk management as well. So please join next week. That will be after the close. I'll try as much as possible to cover across asset classes and trying to give you different time frames for your trading. I hope you enjoyed today. And if you have questions, please send me an email. If you like those webinars, please, you know, be active on social media, retweet, like, just putting some traffic is really helpful, and that gives me a bit of more energy to produce more free content. Okay, thank you very much, all of you. Have a good day of trading, and hopefully I'll see you next week. Bye bye, everyone.